I'm Sarah Borgson-Keto. In conjunction with New Street Week 2021 Investor Conference, I'm speaking today with Brian Davis, President and CEO of CatchMark Timber Trust. Brian, thanks so much for joining me today.
Of course, glad to be here.
What has been behind the run-up in timber prices? How much runway does it have? And how is CatchMark poised to benefit across its portfolio?
So between 2007 and 2011, there was significant industry capacity that was taken offline, either completely shuttered down or brownfielded. And from that period of time, you also had a combination of the devastation of the mountain pine beetle. So part of those closures were related to not only the economy at the time, but also because of the softwood availability in British Columbia because of the mountain pine beetle impact. And even though we've seen capacity grow in the milling operations by 20% since 2018, we're still under capacity relative to where we were back in 2004, 2005, 2006. You combine that period of time with the aging of housing stock. Houses today are about 40, 45 years old. Back in 93, their average age was about 25 years old. So when you go through this period of time, we have essentially have underbuilt housing, and the housing that we do have has gotten older. You combine that with the demographic trends. I hate to tell our millennials, but they are actually human and they're getting older and they're going through household formations and experiencing life the way on a regular way basis. So you combine that with low mortgage rates and you have this big wave that's coming through of saying, boom, here we are. We want to move out of the house. You combine that with COVID, which actually I believe had an accelerant that goes along with this, of this being able to work from elsewhere. And I understand this is a REIT conference and our friends in the commercial real estate space. There's still going to be a place for commercial real estate, but homes are now being retrofitted or being built new in order to accommodate slightly larger square foot, repurposed areas in order to have the work from home element. So you have mill capacity that had gone through a contraction. You combine that with demographics, you combine that with aging housing stock, then all of a sudden you get these demand fundamentals relative to the supply on the lumber side. Boom, you get these lumber prices that go along with that. The question that we normally get that goes along with that is the duration. We see it as a 3 to 5 year period of time that these types of prices, now maybe not at $1,300 a 1,000 board feet, but it's going to be well above historical averages regarding for lumber prices. So how does CatchMark participate in that? And then we kind of opened up with that a little bit. It's really the same story that CatchMark has had since our IPO in 2013. Prime timberlands, high demand mill markets, superior management. So how we take advantage of that is we had identified essentially 6 markets of which we participate actively in. 3 of those markets today that we determined as being high demand mill markets, meaning you had high quality counterparties, strong mill operators, diversification of end markets where those products went into. And so what you see there is wood only travels so far because it's 50% water and 50% carbon. And so when you center around these centers of excellence, as it were, as it relates to mill infrastructure, what you end up having is this consumption rate that is in excess of the growth rate. And we're starting to see that now is, while our timing might have been a little bit off, we knew our thesis was ultimately going to be right. We actually saw in the first quarter this year a 9% increase in our product pricing. We anticipate keeping that because of the demand fundamentals that go along with that. You combine that with our delivered wood strategy, we actually act as a supply chain component to help support these mills and the mill infrastructure that goes along with that. So what ends up being is that we are the first call because we're that incremental volume that can get into the mills. Now those mills are operating at 90, 95%, which is typically higher than historical averages. They are average around 80%. They can't really add more shifts because there's a labor concern that goes along with that. And so really what they have to do is making sure that they have a stable supply of volume. And that really comes from someone like CatchMark.
Have any pandemic-related disruptions to harvesting worked their way out of the system by this point?
Yeah, so we were talking this time last year, some concerns regarding demand coming from the mills in of themselves. The good news is for trees, they don't catch COVID. Forestry is socially distanced in of itself, but what was happening was at the mill level. So we were not impacted because trees continue to grow. How we were impacted was essentially a deferral of our harvest until the mills got back up and running. So a mill may go down for 1 or 2 days. You do that over a month. The next thing you know, you lost a week, 2 weeks into production. And what we've seen is those mill operators have turned around.
Can you describe CatchMark's capital position as well as the current environment for possible divestments or investments?
Yep. So we've been very consistent regarding our capital allocations. Priorities, first and foremost, was liquidity, 2, our dividend, 3, reduction of leverage over time, acquisitions, and then share repurchases. And what we've seen, how we've allocated our capital has really been a balanced approach. It's been a reduction of leverage, some share repurchases, and we really haven't had the opportunity to make much in the way of acquisitions. 2020 was a very quiet year as it relates to that. But what we did find is when we were having capital recycling activity is that when you buy quality, which we have on the way in, what we have found is for greater liquidity when we're looking for divestitures on the way out for some of our larger assets that have reduced productivity characteristics because we've harvested over them over a period of time. And essentially, there would be a neutral effect once we sold those assets and pay down debt, leverage, and do share repurchases. As it relates to the acquisition market, our ultimate bias is to grow our assets over time. And so what we have seen is still a rather modest acquisition pipeline. As we sit here today, we target that $5 to $25 million acquisition size, which is smaller than what you'd see from our natural peer set making these types of acquisitions, but it's been slow to build. And some of that has been a direct result of the impact of COVID. And so there's a bit of a pipeline of opportunities that we would anticipate seeing really going more into 2022 than in 2021, but we would anticipate that growing as we go through the year in of itself.
Brian, thanks so much for your time.
Absolutely. Thank you, Ms. Sarah. Do appreciate it.
And for more news and information from REIT Week, be sure to visit NAREIT's website, REIT.com.